What's up, everyone? Sam Sharp here. Today we have a very good reason to look to reach out and to talk to the people that are paying attention, that want to pay attention. Big day in the financial world as we have released Fannie Mae's update to the lending program, allowing buyers now to put 5% down when purchasing a multifamily. So when you're buying a primary residence, you can put 5% down. And this is a big jump from where we were just for the past few years of, requiring anywhere from 15 to 25% down. So very good news. And today I have a special guest joining us. Now, this is going to be fun because I have to figure out how to invite her to do this. It's been a while, but let's see if I can get Miss Brie Schmidt on here, and she's going to join us. And just sent the invitation. Let's see if it goes through. And then, oh, there we go. I see. What's
Hey,
up? How are you?
good. How are you?
I'm doing
I'm
well.
so
It's so funny
excited.
'cause I imagine myself doing the same thing when we're looking at this, or both been trying to figure it out.
All right.
Yeah, well, thanks for jumping on here. This is a pretty exciting day, I think, in our world.
It's very exciting. So I wanted to step back, if we can, first and talk about prior to 2019 when we had the Home Possible program.
Yep, right at July
So
19th of 2019, or July 17th, sorry.
it was when it went away. Well, it
Yeah.
didn't go away. So that was a Freddie product,
Yep.
correct?
Freddie Mac had a program that allowed 5% down, and we used this a lot for buyers that were buying in targeted areas. There were no income restrictions. And you're correct, it didn't go away in July. What happened in July is that they enforced the income restrictions, so that knocked out a big pool of buyers who normally would have used the program.
Yeah. So that was like the primary program that we
Right?
used up until 2019. So we had to look up certain census tracts. Like there was like a map you would look at. And if it was within that map area, you couldn't make more than like $85,000, right?
Yep.
And if it was outside that map area, which included areas like Avondale, Albany Park, Portage Park, Irving Park, right? Where in the outside area you could make whatever your income was. Inside the map was like Lincoln Park, Bucktown, right? Those sort of areas. So when the change happened, the change said essentially that you're capped at, I think, around $84,000 a year
Yeah, it was
income.
like 80%. At first, it was 80% of the median income. They did uh, update it to say you could go up to 100% in certain areas, but it didn't help us much.
Correct. So essentially, like, even if you needed rental income to qualify, that would then count towards your cap. So it really was only like it only worked on approvals of, let's say, 350 and below-ish, you know?
Right. Assuming you had
Um,
no debt whatsoever, because if someone had any debt, you would need more income to qualify, because
yeah.
that was the case. I had talked to Freddie Mac, to the board, several times about it and said, listen, you're knocking this out because no, if anyone had, assuming no debt whatsoever, it was just under $400,000, no one could qualify. I'm like, you would need the extra income to qualify, but then you make too much for the program. So it was a dark day in our world,
It's been rough ever since,
right?
honestly. We've seen a lot of portfolio programs come up
Hmm.
because really your only option is FHA, which FHA is actually a really good program. The challenges with FHA though are that the income limit or the loan limits for 2 to 4 unit properties are like $300,000 less than conventional. And then, of course, the self-sufficiency test, which pretty much knocks out the ability to buy 3 or 4 unit properties. And
Right.
then there was really nothing unless you did 15% down on a 2 unit or 20% down on a 3+ unit. So I'm really excited that this sort of program is coming back, and I can't wait to hear what you found out so far.
And I think for people that are tuning in and are watching this, it's important to know. So what we're talking about is the ability to buy a multi-unit property, so anywhere from 2, 3, 4 units in a residential property, as long as it's your primary residence, and you're able to buy this with a lower down payment. And as we've gone through, we've talked about historically how this was a great option, and then it went away because there were restrictions on the program. We then turned to different loan programs, FHA being one of them, like looking at these types of loans because they allowed for a buyer to purchase and leverage their cash, or to buy and enter the market sooner, which is important. If you're looking to buy a home, I think that, I mean, let's just take a quick look. I mean, let's talk about some of those properties that people would have bought back in 2019, right? Or even going into 2020, the value on those properties now, right? If someone purchased in and they could only put 5% down, I mean, these people would have actually 20% equity in their home by now, right?
Absolutely. Yeah.
So there's so many good reasons on why this is a very exciting opportunity for people and for house hackers out there that are watching. I mean, this is the basis of the model, is trying to stack as many properties as you can, bringing less money to the table. So I'd like to.
So that brings me to my first question.
Yeah, I was going to say, why don't we do a Q&A on this, because you're always really good at this.
So first question is, if I currently own property, right? Let's say I house hacked with an FHA last year. I've filled my 1-year occupancy requirement. Can I use this program for my second property?
Yes. So this is a Fannie Mae conventional loan program. Really, all that's changed is that they will now allow you to use a lower down payment on multi-units. So now we're following the guidelines that we would follow for a single family home, which is huge. Now, a lot of people have been talking about this for weeks. I wouldn't release any details because I'm just, I'm cautious that way. But now that we've actually launched this today, we're locking loans right now for this program and getting clients in there. We're finding that the guidelines are following exactly what they do for Fannie Mae. So you can buy up to 10, technically, if this stays around for their 10 years, let's just say, and you don't own any property, you could buy one property every year. So for the next 10 years, you could put 5% down on multi-units for your primary residence.
So there's no limit to the number of times you can use this program?
No, once you get to 10 properties, Fannie Mae doesn't allow you to have that many residential, more than 10 financed residential properties. So technically the limit is 10.
But if I can buy 10, my husband can buy 10.
Yes, absolutely.
Okay. But let's talk about that real quick, and hopefully I'm not putting you on the spot.
Please do.
Something changes. Once you own 4, like if you have 4 properties in your name, you're good.
Yep.
But once you get to 5, it changes some of the qualifications. And I remember one of those restrictions is that you can no longer cash out refinance on any property unless it's your personal residence. Is that correct?
I would have to check on that. I wasn't aware that there was no cash out refinances on any property allowed. And I mean, that doesn't sound far-fetched by any means. Like, I'm sure that could be a thing. So I'll have to check out if that's the situation. Once you get past 4 properties, there are a few additional restrictions, meaning you have to have a credit score above 720, 700, usually it's between 700 and 740, depending on the lender. And you also have to have additional assets and reserves. You get to the point where you have to have 2 months worth of reserves for every property that you own. And as you get above 4 properties, you have to have 6 months worth of reserves. So when you're in this position and you start to stack properties, you are going to have more reserves in the bank, and you're going to have strong credit.
Okay.
I'll have to get back to you on that cash out refinance. First, I've heard about it, but I don't doubt it.
I know that was an issue. Must have been like 2015, 2016. That was the rule. So I don't know if it's changed or not. So with this program, me and my spouse can each do it as many times as we want, as long as we fulfill our 1-year occupancy requirement, correct?
Correct.
And is there any, does it matter what area we buy in, or it's any area?
Nope, any area. So don't have to be a first-time home buyer. You're not restricted to certain targeted areas or other areas throughout the country. I mean, you have to be there. It's a conforming loan, right? Conventional. So you have to meet the loan limits. But now with 4-unit properties being well over $1 million, that's a pretty big footprint there. So yeah, no geographical restrictions either.
And what about credit score? You mentioned that, was it still 620 credit score minimum?
So, I mean, that's an interesting topic because, yes, the minimum required credit score when buying a property through conventional financing is a 620. Once you have below a 660, though, between 620 and 660, you're going to have a very difficult time getting PMI, or private mortgage insurance. Because, again, this is a conventional loan, so keep in mind you will have PMI. So most people will have difficulty being able to get approved if they have below a 660 because the PMI may not be available. The other factor to consider is that because this is a conventional loan, it's a Fannie Mae product, not Freddie Mac this time. So Fannie's the one giving us the green light, although I wouldn't be surprised if Freddie Mac followed suit here shortly. But the way that it works is that, Fannie Mae, I got sidetracked live in front of everyone. This is great.
Mom brain, call it.
What's that?
Mom
brain. Well, in my defense, I did hear the stairs coming up in my office, and I have my kids are home this week for Thanksgiving, and I was about waiting for the door to pop open and to see someone come in and go shh and see they do that. But I was talking about what was the
score between 620 and 660.
Thank you very much. All right, so So going through with this is a conventional loan. So what I was going to say is you do have to have an approval through the automated underwriting system. So Fannie Mae uses DU, which is desktop underwriter. So when you're going to use this program, if you have a 620 credit score, sure, you might meet requirements, but at the same time, chances are you're not going to get the approval. And that's something we'll have to watch. I haven't seen any overlays so far on the first few we've run today, because what happened is that you couldn't actually run this program through an approval through Fannie Mae until today.
Yeah.
You know, so it was, and we didn't have access until roughly like 10 a.m. So it's like an hour and 11 minutes deep on this, and we're running these through, and I'm looking at the findings, and I don't see anything that says anything out of the ordinary. So just keep in mind credit score requirements. Yeah, technically you could have a lower credit score, but it's going to be difficult. You're also going to see some tremendous rate adjustments when you start to get below a 680, below a 700. So those interest rates will be much higher. Outside of that, though, and just in comparison to a single family home, one thing to keep in mind is that we're seeing only roughly about an eighth adjustment to the interest rate on these. So if someone was buying a single family home and they were getting 7.25% for that single family home, this would really mean that they would be getting an interest rate of 7.375. So about an eighth difference on the interest rate, which is really great.
Yeah, that's definitely, that was one of the issues with these portfolio products we've been dealing with the last couple of years to help fill that gap. Is they had, 1 to 2 points up front, right? They could set their own interest rates. We were seeing, 1 to 2 points higher on the interest rates, just to be able to use these programs. And then they were only 3 to 5 year balloons. So is this a 30-year fixed product then?
It is, yeah. Conventional 30-year fixed.
And we talked about credit. What about any other restrictions outside of normal? What about PMI? Have we seen PMI rates yet?
I've seen the PMI rates. They're a little bit higher, not a lot. So it's kind of, without going through all the calculations, it's basically going to be about 0.2% annually. When I ran through a scenario for one of the clients this morning, their PMI went up roughly about $45 from what it would have been if it was a single family home, and that was like a $550 price point or loan amount. So it was not bad at all, really. So I'm very surprised, and this is also why I've been hesitant to push it too much, is because I anticipated much larger interest rate adjustments. I figured that the interest rate adjustment would be so high that you'd have to pay so many points to qualify, and I also was expecting that the PMI was going to shoot through the roof. But it looks like, well, let's just say Fannie Mae wants to lend money on this product, right? The PMI, the mortgage insurance companies want to insure it. And I don't think that's a surprise, though, right? This is, we're in a position right now where volume in the industry has slowed down tremendously compared to what we're on pace with in the past few years. And although things are still going well, they're a fraction of what they were. Well, when we see these programs come out, this is because, Fannie Mae is a business, right? They want that, and in their business, they make money by lending money, and they want to lend money. So they want to support and build communities, but it is a business. So when I start to see this, it's great, and it's nice to see that they're actually putting this out there to make it accessible.
So let's kind of do a quick comparison between FHA, which people are mostly probably familiar with, and this sort of program. Yep. Both of them don't have any sort of income limits. FHA, you can only have one at a time unless you have a qualifying life event like you moving or whatever. And that comes with certain restrictions. So this program, you can have as many as you want up to your 10 max. FHA has an upfront mortgage insurance premium of 1.75%, but this program has no upfront fee to do the loan, correct?
Correct. No upfront mortgage insurance, and then the monthly mortgage insurance can be removed after you have 20% equity, wherein compared to FHA, it's for the life of the loan. Well, technically with FHA, if you put 10% down, you can have the monthly mortgage insurance removed after 10 years or 11 years. Mm-hmm. This program has no stipulations, so as soon as you have 20% equity, you can have that removed.
Awesome. And you said the PMI rate is what, 0.2%?
Some providers may require that you, in order to get the PMI removed, you actually may have to have 35% equity. To go back through, I'm going to have to circle back on that. We're going to have to do a follow-up on that, because there were some stipulations where some servicers would hold you to that, and I want to look into that and see if that's going to be a situation on this. So I don't want anyone to get into this and then find out like, hey, I can't get rid of my PMI. What's going on here? And then you're looking into an overlay, and it's like, oh, Fannie says you're going to have 35% equity. So I'm going to circle back on that.
Okay, and you can get that removed by doing what we call a BPO. Mm-hmm. So I did that with my house. Actually, I used a 5% down loan in 2019 on my personal residence. So it was single family. It wasn't the Home Possible loan. We did a major renovation to it. And a few months later, I qualified to have my PMI dropped on it based on the BPO. And a BPO is a broker price opinion. So essentially, they sent a realtor to my house to take pictures, right? It wasn't a full appraisal, give them an opinion of value. And then the bank saw that I had enough equity and was able to drop my PMI. So that's always something you can do, especially if you're doing the BRRRR strategy.
Yep.
We're going to do a full refinance to be able to drop that PMI. So when you said the PMI on this is 0.2% of the annual loan cost, is that correct?
Higher than a single family home, meaning there's been an increase of 0.2.
How does that compare with FHA's PMI? Are they quite similar?
It's going to be higher, a little bit higher on the monthly, because FHA brought their monthly mortgage insurance down. So, that's been one of the benefits we've seen over the last year as FHA lowered their monthly premium down. So I think that it's going to be, well, I shouldn't say higher, it's be comparable, pretty much the same. No self-sufficiency test, right?
Yeah, huge.
Something we're very excited about. There's no stipulation based on the property rent rolls, which is good.
Because nothing passes self-sufficiency anyways.
You can still use rental income from the subject property to qualify, which is great. We'll use 75% of the leased, the rents that are in place, or market rents if there's no lease or if it's month to month.
Oh,
so that's good. I mean, it's
very promising, very exciting news.
Yeah,
this opens up a lot of.
It's a conventional loan, the same. It's basically treated the same as everything was when we had to put 20 or 25% down. It's just in this case now they allow for the lower down payment, which is great.
Okay.
I hope it stays that way.
Yeah, because the Home Possible still had a lot of restrictions we had to work around.
There could be, yeah, there were some. Although that was, I love that. Home Possible, though, we really started utilizing that program a lot when we came out of the crisis back in 2008 when things started to come out, after things crashed in 2006. And I see this as a similarity. And this was what I was most excited about when the program came out. Don't get me wrong, I'm very excited to use it. I want to use the program. And as you know, I'm big in this space, or at least I was, and now I'll be bigger again because I like to run with these programs. But what really got me going on this was again showing that liquidity in the market, showing that they want to lend money, because this is what we saw coming out of 2008 when Home Possible lifted those restrictions and said you could use the program in targeted areas with no income limits. Well, here's another idea where we're seeing this, where we're seeing them saying like, look, we'll lend money. So this is good news, and I don't think it'll go away anytime soon. And maybe we'll see some other programs come out that are a little bit more aggressive. It actually would be nice to see Home Possible come back and lift those restrictions again, because one of the benefits of Home Possible is that the interest rates were more aggressive. They were lower because you didn't have as many adjustments to your rate. This is a Fannie Mae product with no cap on those adjustments, so the rates could start to get pretty high just in relation to what we're seeing anyway. But again, not much different than a single family home. So
let's talk about that for a second. I've been in this business for almost 10 years. I've been working with you for almost 10 years. Mm-hmm. I am at Second City Real Estate. I work primarily with investors and pretty much house hackers. Like that's my business, right? Northside Chicago, 2 to 4 unit properties, house hacking, right? And I've helped clients buy, 2, 3, 4 properties over the last couple of years and really stack up their portfolio. So this is a solution that really comes into play when we're talking about multiple properties and like long-term strategy.
Yep.
There's 3 problems I have right now. One was loan programs. Like I said, anything, if you couldn't do FHA, you had to do 20% down. And in the middle, we had these portfolio products, which were quite expensive and short term. My second problem is obviously inventory, right? We are down year over year, more than 20% in inventory, and it feels like 50%. Whereas,
right.
I analyze, so every day, 3 times a day, I analyze properties between Pilsen, Jefferson Park, and Evanston. So I've done for the last 12 years. Every single day, I get every single listing, and I run numbers on them all. So usually in spring, summer months, right, I'm running, let's say, I'm seeing like 200 properties a week I'm running numbers on and finding maybe 10 to 15 that meet our minimum criteria for investing. This last summer has been terrible.
Yeah.
I'm maybe looking at 50 to 60 properties a week and finding 1 to 2 a week. So it's a huge difference. So I'm hoping the spring market kind of bounces back, because this year is kind of just a wash at this point. But the third problem I have is interest rates. So it really impacts the investor side of things, right? If you're going to put, even 25% down on $1 million property, that's a 6.25% cap rate. that doesn't need any, that's fully renovated, like that's a good deal in our market. But when you run the numbers, he's putting 25% down, which is like 200 and something, $250,000, and cash flowing $200 a month because rates are 8% for non-owner
Right.
occupied. So I'm hoping, right? I've been following lots of economists, right, and really smart people talking about how the Fed isn't going to be raising rates anymore. What do you think is going to happen in the next 6 months?
I think rates are going to go higher.
You think so?
I do, yeah.
How?
I think we're on the bottom of a trough right now because we've seen them come down recently. There's been some positive news, but I always try to read between the lines a little bit. And one of the resounding, which has been just chanted over and over and drilled through like every article, is higher for longer. And I don't think higher for longer meant for a month, right? When we saw things go up above 8%, we went up into the sevens, and then we went right up above 8% for a little bit. And now they've come back down in the lower 7% range. There's a lot of parallels between issues that we saw when interest rates were much higher than this back in, starting in 1975, interest rates topped over that 8% marker. Well, they didn't come down from there for 18 years. They stayed up, and that's where you hear all the glory stories, if you will, of people like, my mortgage was 22%. People wear it like a badge of honor. But there's some parallels economically in the fact that it was going. So if you think about it this way, because I can share viewpoints and data on both sides of this and argue both of them confidently. So just to try and ride the line in the middle and look at some of the information. So you go through and you look at that pattern of interest rates. When we talk about interest rates going down in 2024, a lot of the arguments, if you will, or just the justification of the data says, well, there's an election year, so there's a good reason that we would see interest rates go down there. They're also going to talk about recession. We have a recession, we have an issue, and we see that interest rates will go down because there's going to be an economic hardship there. But something that's important to note is that from 75 to 1993, that 18-year stretch, there were 3 recessions, actually, and there were 4 elections. So, and rates spent a lot of time above 10%, going up to 16, 18%, a lot higher. They had a problem with inflation. Unemployment was at a very high level, going up above 10%, so that was a problem. And you also had the Iran controversy, which is an energy shortage, crisis, oil crisis, right? Price of oil was going up. Now, one thing I will say, if anyone's noticed, I have, and it's been great, is that gas has gone down recently, and there's talk that it might actually come down a little further, and that's based off of demand. So a lot less people are driving, believe it or not. So it's driving down that price of gasoline. So we'll see what happens there. But playing devil's advocate, I'm just saying that interest rates hopefully will come down, but I would not be surprised if we haven't seen the worst of this yet. We'll see what happens going through this holiday season and as people spend money and as we go into the new year. If we've hit a wall and people stop spending money, then interest rates hopefully will come down. If we don't and we see a consistent pattern, then I would not be surprised to see them go up even higher than what we saw before, which is not what we want to hear, not what we want to say. And I hope I'm wrong. I really do, because that would be great for everyone if I am. But I could see it going that way. Probably not what most people want to hear right now, I'm sure.
So yeah, I've seen a lot of parallels drawn between the 1980s and today, right? And that this isn't a 2007, 2008 issue. This is the 1980s issue. But you have to understand, I hope they understand that just because it seems similar to how it was back then doesn't mean it's going to be the same. And I think there's going to be a lot of issues if rates stay in the 7-8%, and it's really going to hamper the whole real estate market, to be perfectly honest. Because why would you move unless you absolutely had to?
Right.
And pay so much more than, I think, what's the stat? Like 55% of mortgages are under 4%, something like that.
Yeah, that's like 55% is under 42% of the homes in the country are owned free and clear, and then the mortgages that are out there, I think it's like over 60% are below 5% actually. I have to go back. I have it written down. I've made social media posts about it, right? I have stats and share all the fun stuff about it, but it's an overwhelming number. There's still a lot of people buying homes, right? 7 million people this year, 6.5 million people last year that are buying homes at a much higher interest rate. But and just to go on the other side of that, right? Like I said, there's definitely ways you could see parallels. but then you could go back the other side. Let's say, what would argue for interest rates going down? Why would rates go down? One of the differences between, you can see the similarities between now and the 80s. One of the differences, though, is, and this is where I think a lot of people get into, is the cost of living in general. You know, in the 80s, the economy could support more of the cost of living based off of the amount of someone's wages that were going towards their housing versus now. Now there's a tremendous imbalance. So you're in a position where if housing goes through the roof, no one can afford to rent, no one can afford to own, and they're spending half of their money just to try and eat. So that's a real problem. Affordability would be, I think, a big driving factor on why we would probably not see interest rates go up to 20%, right? And not see things go that way. Yeah, I know. Yeah, I know. Here's what I think what could be a very perfect world, and what I would be absolutely fine with. Interest rates could just stay where they're at right now and stay in the 7% range and stay there, and stability is really what we need. If they went to 8%, stay there. We need stability. If we have stability for an extended period of time, it's going to be much easier for people to gauge affordability and to try and attack this from some different fronts. Because right now, while things are moving up and down, it's really hard for all avenues of the industry to try and make a plan and try to come up with a strategy. So we'll see what happens. Don't get me wrong, I would love to see rates go back to the fives. That would be amazing, but maybe not.
High fives. But you mean, our world of residential real estate, right, is part of the impact. The other huge part of the impact is going to be the office building space, multifamily, and hotels, which typically are commercial loans, which have 5-year balloons, or have rate locks for typically a couple of years.
Yeah.
So there's already been bankruptcies in the multifamily world. There's already been, I just got an email last week about an investment opportunity for a syndication deal where their rate lock is coming up January 2024. They will foreclose on that property. They will lose it.
There's no loans, right?
And they need to fire sale it at a 6.5% cap rate because otherwise they're going to go bankrupt. So we're already seeing a lot of that in the multifamily world, that if rates stay this way, it will absolutely collapse these local and regional banks that hold these notes.
That's good. I mean, I think that's actually inevitable. I think we're going to see a lot more of that. We are seeing that every day. I was reading earlier about some of the issues that they're running into with some of the foreclosures that are happening, foreclosing on the landlords for some of these commercial properties. And that's a real issue. Obviously, the cost of borrowing money across the board. It's not just residential homes. It's credit cards, student loans. All these different types of debt are going to be higher. Now, on the flip side, people are making money on their money, which is great, right? There's a positive there. But I guess that how this plays out. I mean, I don't think anyone's smarter than the market, right? But history does have a way of repeating itself, and if depending on how things go historically, that could get ugly, or hopefully, maybe in this case, we've learned from our mistakes, and we'll see how the Feds balance things out. I don't know. Honestly, I don't know. I call it hope for the best, plan for the worst. That's a strategy that we always take. Just make sure you're comfortable with what you're paying, and don't, for unsolicited advice for anyone who might watch this, back when we had the crisis, because this is obviously not 2006. I don't want to go down a laundry list of reasons why this is nothing like the housing bubble and the crash that we saw in 2006. But one thing I will say, there's a similarity in 2006. Now there was a tremendous amount of people who unfortunately lost their home because they couldn't afford it, right? They had taken short-term notes, they adjusted, those payments went up, and they couldn't afford it. There was also a very large portion of people who sold their property short just because they thought they were losing. They thought, I paid this much for this property. Someone in Arizona would be like, Scottsdale would be like, I paid $300,000 for this property. It's worth $200,000. I'm getting out before I lost everything. It's too late, right? And then fast forward, that property selling for $1.5 million in Scottsdale. So it's one of those things that going through all this, if you hope for the best but plan for the worst, you find yourself in a position where you can hold on to the long game, because long term, real estate has won long term over 90% of the last 81 years, right? We've only seen, out of 81 years, we've only seen property value go down 7 out of 81 years. And in that, the majority of that was the housing crisis and the bubble. Mm-hmm. And if you take it by decade, obviously that's if you go through the 10 years in the decade, but if you take it by decade, even in the housing crisis, those decades still appreciated. So, and I have some
Yeah.
fun stats. I'm doing a video on it right now and a presentation on it that I'm sharing. That's why it's like right off the top of my head. But you know, if people can just hold on regardless. Make sure you're comfortable paying for it, and it'll be an amazing time.
Yeah, something like 11 of the last 13 recessions, we saw an increase in property values, not a
Yeah,
decrease.
they don't.
With the dot-com bubble in the 90s, which I think it went down like 3 to 5%. And then obviously the housing crash where it went down about 20%. But the chances of that happening again, statistically, are very improbable.
Yeah, the cards are stacked against that, saying I would say it's incredibly unlikely. So awesome.
Well, yeah,
I
I'm really
digress. We've gotten
excited.
way off track.
Yeah, I'm super
Yeah.
excited that this program is coming out. It's live now. Today's the first day that you can actually run it through underwriting. If you're looking to house hack in Chicago, right, I'm your girl for sure. Hoping that, you know, we don't really see much out of the winter market, to be perfectly honest. This is definitely our slow season, you know, but come typically end of April, early May is when we start seeing things pop up. And I'm hoping that, you know, if we listen to the NAR, the National Association of Realtor Economists, said that he thinks he's predicting rates in the low sixes by spring. So
that would
if
be
we
great.
get rates in the low sixes by spring, we've got this program to use. And then I think inventory will come back to normal, and we should have a very exciting year in 2024.
I like it. It's going to be exciting one way or another. We want to have a positive, exciting year, so we'll see how that goes.
It's
So
going to be interesting one way or another.
yeah, we'll see. We'll see if they say that. So, well, if anyone has any questions, feel free to reach out at any time. Wonderful. I'll talk to you soon.
Thank you. Bye.